Well, welcome everyone. This is another one of our podcasts in our podcast series, and I'd like to introduce John Ng from Maison Placements. John is an expert in the precious metals space, amongst others, but that is his key topic today. And before we get into it, and I might get John to just do a little background on himself, I just want to do a little bit of an introduction here for those who are newer to our So hello and welcome to Lighthouse Outlook, the podcast dedicated to guiding you through the complex landscape of investing. I'm your host, Dave MacNicol, president and founder of MacNicol and Associates Asset Management. Here at Lighthouse Outlook, we delve into the essential strategies and insights necessary for making safe, informed investment decisions. Our goal is to equip you with the knowledge to confidently navigate the financial markets. Each episode will cover crucial topics from market dynamics to innovative investment strategies, all designed to help you secure your financial future. Lighthouse Outlook is available on all major podcasting platforms, including Apple Podcasts, Spotify, and YouTube. For those looking to enhance their experience, I encourage you to register on our website for free. By registering, you gain access to exclusive content and the opportunity to participate in live podcast events where you can engage directly with our expert guests. So subscribe today, become part of our community, and take the helm of your investment journey. So let's dive into today's episode. So hi, John. Thanks for putting up with that intro, and welcome, and good to see you again. Maybe just give us a little background on yourself. What's your career? Where's your career taken you?
Well, I guess I've been following gold, the precious metal, for more than 4 decades now, and that sort of ages me. Goes back to my early days when I was born and educated in Montreal, and was an asset manager, and I looked at gold as a commodity. But then the more I did the research, I realized that gold is not only precious, but is probably the answer to and a lot of our world's problems, and particularly a hedge against the problems. And in the 70s, it was a hedge against inflation, and today it's a hedge against not only currency debasement, but also the geopolitical tensions. So I'm based in Toronto, and we have done business with most of the major gold players, as well as resorts here in Canada. And, it's been a challenge to follow gold, and I've seen gold at $32 an ounce and watch it go as high as $1,000, and everybody said it wasn't going to go any higher. And today, of course, we're flirting $2,400 again.
Yeah, it really is. And how did you start your firm, and how did it decide to focus in this space?
Well, I worked for a bigger firm, Maison Securities, for some time, and I working for a big firm, as you can appreciate, David, you want to be a master of one's own destiny. And in 1985, I and a couple of fellows, we acquired Maison Placements, and with the help of some banks, Swiss Bank in particular, we have been now, I guess, one of the oldest firms on Bay Street. We have outlasted a lot of firms, and our expectation is to be around now for some time to go. We follow resources. We have acted as an investment bank and sometime as a merchant bank, and it's our professionals believe that resources, as we look ahead, are definitely the assets of choice and to be invested in.
Well, let's jump into it here. Just in preparation for this, I've jotted down some really general questions I thought might be interesting to start a discussion. And maybe just take us through like the history, the origin of precious metals being used for some sort of an exchange for goods. And then why were gold and silver chosen? Like, why wasn't it some other type of hard metal or something? There must be some reasoning behind that. Just take us through the history.
Well, gold has been around for probably 6,000 years. Originally, and I'm sure the shiny metallic, the fact that it wasn't readily available, made it a medium of exchange. And that is one of the lessons about gold. It is a medium of exchange. For a time, for many years, currencies were based on a gold standard. Even in the U.S., they had not only a gold standard, but they also had a silver standard in the Civil War. China itself was once on a gold standard and also had a silver standard. It's a precious metal, and when you think about it, there's not that much gold, but around the world, there's not much silver. And if a central bank could only produce as much dollars or lira or whatever as the gold that they held, it made that currency all the more valuable. And for a long time, that was the case. But it was only in 1971, when the Americans, President Nixon, went off the gold standard because there was just too much debt around. The debt, where did the debt come from? It came from his predecessors. President Johnson had fought not only the Vietnam War, but he also believed in the Great Society. In other words, he wanted to give out tax breaks. He wanted to spend for public spending. And they call it guns and butter. And that you really can't do it both. You have to, somebody's got to pay for it. President Johnson's case, he just left it for his predecessor, Richard Nixon. And Richard Nixon found out that in fact, central banks, that the dollar was not good as gold because the central banks were demanding the country's gold and instead of dollars. And so they're exchanging that, and the American gold holdings were going down pretty fast. So he went off standard in 71, and he convinced everyone that, well, you have the backing of the United States faith and credit. And in fact, ever since then, we've had just a series of booms and crashes and booms and busts. And the reason I believe is because there's no discipline of currencies. We have it today, in fact, David, when you look at America's debt today under President Obama, we can remember President Obama, debt at the time was astronomical, was off the chart, $10 billion to $1 trillion. Today, it is $35 trillion. Now that sounds like a lot of money, but you know, in 1 hour, the U.S. racks up $300 billion of debt in 1 hour alone. That's in 1 minute. That's $4.5 million a minute. So that's what's happening is that the Americans have been able to print all this money. You're going to ask now, who is going to pay for this? And what's happened is that for a long time, the international markets, they were happy to buy U.S. debt. But now, given the tensions of not only Mr. Biden, but before Mr. Trump, and the likelihood of looking in the next presidential election is that they will be spenders, is that foreigners are getting tired of buying U.S. debt. And so that left it to the Federal Reserve, their own central bank, to buy that debt. And you had quantitative easing, and that was the Americans. They were able to buy their own debt. But what's happening now, David, is that the Federal Reserve is now doing quantitative tightening, and in fact they have something like $8 trillion, a little less now, of American debt, and they've been selling. The Americans have a debt crisis. It's a debt. So if the foreigners aren't buying American debt, and if the central bank isn't buying it at the same rate, then who is? And that is why U.S. purchasing power has declined. I can recall when, and I'm sure our fathers, the 5-cent cigar, or we can recall when houses were $100,000. Well, we liked those days back when you could buy a Corvette for $4,000. We can't go back to those days, and the reason why we can't go back to those days is because of inflation. And inflation causes a deterioration in purchasing power. And it's no coincidence that since 1971, Americans have lost 90% of their purchasing power. So, yes, inflation is bad, but what's worse is the loss of purchasing power. That is why we don't have the 5-cent cigar anymore. That is why we can't buy homes, and it's too expensive. So gold is a protection against the loss of purchasing power. Historically, we have seen it in the high inflation periods or the hyperinflation periods in Germany or in Venezuela today or in Turkey. Hyperinflation destroys currencies. And that is one of the main reasons why gold is a hedge and a protector.
Yeah, yeah. Well, while you're talking there, it made me think a large chunk of our audience here is from the United States. And for many of them, especially it seems in the investment industry, to generalize a bit here, they consider gold to be anti-American. Why is that?
Well, it goes back a long way, David, because gold, as I said, the dollar was as good as gold. You know, when Franklin Roosevelt, when the Americans got into difficulty, at one time, it's hard to believe they could not hold gold. Gold became competitive to the dollar. And so that Roosevelt made FDR said, okay, you can't own gold. And in fact, they confiscated gold. And much of the gold that's held at Fort Knox today is that confiscated gold. Well, it wasn't until the 70s where Americans allowed to buy gold again. And in fact, I can recall that time when gold was around $100, and the day that they could buy gold, gold spiked at $200 and then went down. Because, frankly, a lot of Americans would be able to come up to Canada or elsewhere and buy gold bullion, and they did. And, of course, you could buy gold shares. So there was a anti-government attitude towards gold for a long time. Today, I think, frankly, the American government is ambivalent as far as the role of gold because there, as the last two administrations, there have not been much of an interest in gold. The Republican Party historically has, in the 60s and 70s, talked about bringing gold as a gold standard. And in fact, there were a number of different commissions. After Gerald Ford had problems with inflation, there was talk of a gold commission at the time. And they came out, as with all commissions, with I think about a stack of gold commission books, and it looked at the role of gold in the United States and the future role, and it concluded that in fact the currency is the best protector, but there was no talk of going back to a gold standard. There is gold has a um, almost a contradictory role in American finances. This changed, of course, when gold went to $1,000, and now gold is over $2,000 because there's a realization that in today's world of volatility, that gold is very much a protector of assets. I have stories of in Europe during and after the war that a lot of people, in fact, saved their families and their wealth by emigrating, and they were only allowed to emigrate because they had gold bullion and gold coins. And so it's a protector of assets from that standpoint. And my expectation is that when you look around the world, because gold you can't create like paper dollars out of nothing, gold is in the ground. And unfortunately, in the last 20, 30 years, we've found all the low-hanging fruit, and they found most of the major gold deposits. So the expectation is gold is becoming dearer, and while demand keeps on going higher.
Okay. Oh, you mentioned the current. How does the U.S. dollar, the movement of the U.S. dollar relative to other currencies, affect the gold price?
Well, the U.S. dollar has been very volatile, as I mentioned, since 1971. And it's because it's a fiat currency, that is, fiat meaning that there's no backing, that the Fed can print as many dollars as needed. I can recall after in the 70s when inflation went to double digit levels, it took Paul Volcker the then chairman, to bring in double-digit interest rates as high as 22%, in order to squeeze inflation down. But then the Americans, after whipping inflation, they decided to spend again. And the problem was, in 1985, the dollar became very, very strong because they had higher rates. So in 1985, the government at the time got together with four of the major countries, and you have the G agreement to bring the dollar down. So the dollar has been up and down, and lately the dollar has been super strong. Mr. Trump, when he gets in, has said it is too strong, and he wants to give the American manufacturers a trading advantage by bringing the dollar. The problem, again, it's contradictory, because he is also talking about introducing tariffs, and in fact, across the board, 10% tariffs on everybody, including Canada, and a 60% tariff on the Chinese. Now, as we found in the last time Mr. Trump was around, was that countries retaliate. And the expectation is that will happen yet again. And my big worry is that the tariffs are not only inflationary, because that's passed on to consumers, and consumers pay higher imports. When you go to Walmart, you will pay more for your goods. That pushes up inflation. And when you push up inflation, you also move interest rates higher. So that means you'll get a stronger dollar. So you have a push-pull relationship. And my worry is that, in fact, the tariffs will not only cause a tariff war, but, David, you recall we're also in the middle of a war, with not only in the Ukraine, but a war in Gaza. And we have, those wars are frankly inflationary. The cost of defense munitions, that has pushed up, in fact, the prices. And then you have the Cold War with China. Putting tariffs on it is inflationary. So we have a lot of inflation inputs into the system, and it's almost like you have a big inflationary soup that's percolating away, that's bubbling away, and it's going to be very hard to manage for the next president next year, which is one of the reasons why gold has been very strong, because central banks around the world, they have been buying gold. In fact, they bought out about a third of the world's production every year for the last 3 years. So they have been pushing up the demand. Supply of gold is limited because, as I mentioned earlier, there's less and less gold being found. So that's pushing up the price. And then when you put it into the U.S. presidential election on the uncertainties as to who's going to win, that to me is going to be a big push for the price of gold, and I expect it to go beyond $3,000 an ounce within the next 18 months.
You mentioned inflation quite a bit there. What are some of your best ways to combat inflation?
That's a very good question. Shares in high inflation periods, that means that there's a lot of liquidity. There's lots of money. That is the reason why, David, we have a roaring stock market, because there's still a lot of money around. Notwithstanding the fact that interest rates have gone up, there's still lots of money around. And the stock market does well in the initial period. I think that with the tech stock bubble burst lately, that is driving some money into alternatives. And therein lies the appeal of gold, because there's a rotation. And I think the gold bullion itself and the gold miners themselves have had a difficulty in replacing their reserves. They're digging gold out of the ground, and it's costing them about $1,500 US to take that gold out of the ground. That's the cost of processing, that's the cost of discovery, exploration, that's the cost of labor. Now, gold today is $2,000 plus, $2,300, $2,400 plus. So that's a pretty good margin. Only now are they started looking around the world of increased exploration budgets. But it takes 10 years, David, between the time when you find gold and you're being able to bring it on stream. So the reality is that the gold miners, they look around and they're digging out in some cases of Newmont, digging out 6 million ounces out of the ground every year. They're not replacing 6 million ounces, which is why Newmont has been buying other mining companies. The same thing for Nickel Eagle is that they have to find 3 million ounces every year, replace those ounces, and fortunately, they have been able to do it, unlike Newmont, successfully through acquisitions. So my expectation is the merry-go-round will continue for a while, and it's cheaper to buy gold on Bay Street than it is to look into the ground.
Yeah, yeah. No, that's it's never been more true than now, and the bigger ones are just that's the only way they can replace their reserves, as you say, and keep their stock price stable and growing. Let's go back. You do a. By the way, I just want to plug your commentary that comes out just about every month. It's an excellent piece. You find some great cartoons to spice things up, get people thinking, and just a great overview. So anybody who's listening in here and wants a copy of that or be on the list, just reach out to us and we'll pass your email on to John's office, and I'm sure he'll put you on their distribution list. I do share it with a number of American analysts who might not get it, so for what that's worth. Actually, why don't we go to it? And there's a couple of charts on the most recent one that I thought were interesting. Maybe just going back to, government budget deficits. Talk about that, and I'll try to put this on the screen here for us. Yeah, here it is. That should show up now. Can you see that?
Ah, yes. That's a very interesting one, David. You can see America's budgetary deficit, which is something in the order of $2 trillion now. And almost 8% of GDP, their gross domestic product. I did some research, and you looked at the last 30 odd years of American budgets, and on average, their deficits were no more than 2% of GDP. Here we are today, the deficits are 4 times that. That means the Americans are spending much more than they're bringing in. And it's unsustainable, frankly. When you look at their total debt, it's $35 trillion. That, too, there is a limit. So I'm looking, if you are a central banker elsewhere in the world, you're seeing this, and you're saying, well, the U.S. dollar is the world's reserve currency. The only way that they can pay for those deficits is by printing dollars and inflation. Because inflation, frankly, makes those dollars worth less, and it makes the debt load a lot less. And that is the real undercurrent, and I think, reason why their Federal Reserve, although so-called independent, has been printing dollars in order to make the debt load much more manageable. And so my expectation is that when a country, and I can recall when Greece, when their deficit to GDP approached 6%, that triggered a financial crisis for that country. And the only reason that hasn't yet in the United States is because, as I mentioned, the dollar is the reserve currency, and right now a lot of foreign hold and Americans hold America's debt, but that is unsustainable in my opinion.
Yeah. And there's another great chart I'm going to go to about public trust in the U.S. government, and this one speaks for itself, but maybe you could just comment on it as well.
Well, the old adage, you can't fool people all the time. And my expectation, if I think the American people realize that their dollar, their currency, is being worth less and less and less. I also think that in this polarized world, that they are the extremes, and there's no middle anymore. I think that their courts, for example, when you look at Roe v. Wade, and that the courts have also become polarized. So what happens is that when institutions become polarized, become political instruments, then there is a loss of faith in that government. And I think that's what's happening. I think that's what's showing in those charts is that there is diminishing lack of faith in government. When that happens, I think the American people are bright. They will look for how do you protect one's assets. And historically, it's been gold. And there is, I think, one of the limiting factors down the road is that the Americans will be big buyers of gold themselves.
Right, right. Now, move along. You probably ask this all the time. There looked like there was a risk there for a while that cryptos might be replacing assets like gold and silver, and just had a tremendous run there in Bitcoin. Do you see them being an alternative, or is there something that we should be concerned with, or what's your thinking on that?
That's a good question, David. I think that Bitcoins, these cryptocurrencies, have a role. They are an asset. They are like ETFs. It's created in this financial world and it has a use. But crypto, unlike gold is used by central banks. It is in reserves. It has used as money. That crypto, unfortunately, other than Salvador,
Yes.
has sovereign backing, so to speak. I think that a lot of the central banks are talking about it, the Chinese in particular, a digital currency. And I think that they want to do that, A, to protect their own currencies, but B, it's a way to keep track of money laundering. Because crypto has been a success, a lot of it has been because it's been useful in money laundering. And that is one of the reasons why governments are trying to clamp down on the use of crypto. So I don't think that will happen, that they will abolish it. I think crypto has a role as an asset, but it does not have a money backing and asset backing like gold, and therefore gold has outlasted everything, and it will outlast the cryptocurrencies also.
I agree. Do you think a Western nation will ever return to a form of the gold standard?
I think it'd be difficult under the current, not only regimes, but the political parties. My expectation, frankly, is looking ahead, is I think, notwithstanding what Wall Street is talking about, everybody thinks that inflation is licked. And frankly, inflation is dynamic. It moves up, moves down, but it is always with us. And the fact is that, and I believe that inflation is a monetary phenomenon. If you're going to spend a lot of money and you rack up a lot of debt, that bodes well for the inflation down the road. And if I look at the administrations down in the States, look at our governments, inflation, unfortunately, is with us for a very long time. Will not be hard to go from inflation to hyperinflation. And hyperinflation, we've had periods. The Weimar Germany in the 50s, which was only ended by the Great Depression. And the Weimar inflation happened because, again, the printing of money after the wars, after World War One, tariffs. They wanted to protect their agriculture base, and you had the mismanagement of the government coffers, and that resulted. In fact, they had what they equivalent of the Roaring Twenties. They had a rip-roaring stock market. Everybody thought it was they had made money, and it was all very illusory, of course, because it all ended very quickly. Hyperinflations we had in Turkey recently, or in Venezuela. So it's very easy for central banks to mismanage, and you go into a hyperinflation. And the hyperinflations do not end well. And that's why, one of the reasons why, when you look at the United States, debt just keeps on increasing. It can only end up in one way, I believe, and that's eventually hyperinflation.
Right. Yeah, that's frightening. There's evidence of that around the world. Maybe talk a bit about how Argentina has gone through their bouts of inflation and hyperinflation, and now with one political change, how that's changed. I don't know. Maybe are you up to speed on Argentina?
Well, very much so. I mean, the Milai, well, if you had to cut spending, which is what was done, but there is always constant pressure from the unions to grow and to spend public services and that, and they're still not out of the woods. They have also adopted a pro-business attitude, so they're bringing money in to the country, but you still have capital controls, and that is one of the problems with hyperinflation, and that is coming. Capital controls. We talk about sanctions. We talk about tariffs. Capital controls are all part of government ways that they manipulate money, and we still have capital controls in Argentina. It is not yet. They are not yet out of the woods. So, but the dilemma is, it doesn't take 1 year. It takes years and years in order to extinguish the inflation, and change people's attitudes, and build up the country's coffers. There's always
Yeah.
pressure to spend, and that's the problem.
I think it gives us all hope when you see something like that happen in a smaller nation that's been for arguably almost 100 years dealing with various corruption and various levels of the government and government parties that come through. So I think it's encouraging the way I look at it. Let's move on just to maybe into stock specifics. But before, how is the price of silver and gold tied together? How do they move? Maybe just give people a bit of a sense of when gold gets expensive relative to silver and vice versa.
That's a good question. There used to be a ratio long ago, 65 to 1. And so when one got out of whack, people bought gold or people bought silver. Today, I don't think that there is much of a relationship, frankly. I know some people still talk about it, but tracking it over, it's more supply demand. Silver used to be impacted by was an industrial metal. At one time, when this is dating ourselves, David, when you had the camera and you had film, and
Yeah.
film, a good component of film was silver. And if everybody was using a lot of film, taking a lot of pictures, your silver price, of course, would go up. And silver often was a byproduct of other metals. And so that was really affecting the silver supply. It's not used as necessarily as a monetary metal as much as gold. So the relationship it was a creation, I guess, of Wall Street. It's sort of like the gold oil. There was a relationship between the price of oil and the price of gold. I think it might hold for a very short period of time, but was not necessarily a way to make a lot of money. And at least I found that over the years, trying to trade the different relationships, and that just didn't work.
Yeah, I've heard silver referred to as a poor man's gold, here to put into coins and travel with, and a means of currency, than gold being heavier and more expensive. And silver has a lot more industrial use too, in terms of our phones and any technology. It's probably a heck of a lot more silver than there is gold.
But just a simple iPhone, there's more gold in that iPhone than there is silver.
Oh, okay, I did not know that.
If you took, I think, I forget, it's sort of there's more gold in an iPhone than there is silver. And there's more gold than if you took 300 tons of gold and 300 tons of iPhones, there'd be more gold in those iPhones than any gold ore. I saw something on that order, but it just shows you that how rare it was then. And of course, gold it conducts electricity, and that use is not only pretty to look at, but there is industrial use to it.
Okay, well, that's news to me. I didn't know that. But let's go on to your favorite mining plays right now. Just broad base. What do you like? And if you don't mind, I might put up your list here that you publish with your newsletter thing. I think that's it. Yes. Okay, there we are.
Yeah, I think that um, when I look ahead, one of the problems for the industry is replacing those reserves. So gold mines are not only precious, they're tough to find good gold mines. And Barrick has the largest array of what they call tier one. Those are mines that not only have long lives, but are very cheap to relatively cheap to produce. Barrick has about a 4 million ounce base rate, but they have a joint venture with Newmont, and they run that joint venture in Nevada called the Nevada Gold Mines, and that is the world's largest, probably, collection of gold mines, and Barrick controls that. Barrick also controls in the Dominican Republic with Newmont also a one of the best long life gold mines in Pueblo de Veo. So Barrick has more than 10 top tier one gold mines. Newmont I mentioned, but Newmont has grown through acquisitions, and those acquisitions have not turned out well. So therefore, they are more of in a cleanup mode, and their quest is for those similar common tier one mines, but they haven't been so lucky. They've been buying mediocre assets and trying to shine them up, and that I think is not a great strategy. So my preferred one is Barrick. Excuse me. And then I followed up with a Legal Eagle, which has done terrifically well. It's the largest Canadian producer, and it has an array of Canadian mines and that have a long life and expectations of to grow. Um, and Eagle has also have very good operating team, and my expectation is that they too will do well. They own two of the biggest mines in Canada, Canadian Malartic and Detour, and these mines will go on for 20 years plus, and that's whereas a lot of gold mines they're lucky to have a 10-year life. So um, my emphasis had been on the big senior producers, and then I'm following it up with the what I would consider the developers, and that be B2 Gold, for example, which is developing a mine in Nunavut. They're bringing, in other words, I look at the developers as these miners are going to bring on gold in the next 3 years. And that, as I mentioned earlier, that it takes 10 years to bring on a gold mine, that I want somebody who's already found the mine and doing the permitting and doing the spending that money, and but they will bring on gold in time for the rising gold price. And BT Gold is one of them, and they got a very good management from execution. Um, El Dorado is a also big on the Skouries gold mine, and that is a plus. And then of course there's McEwen Mining, who not only are they in Ontario, but also in Nevada. They turn down the gold bar, but importantly is that they own 48% of McEwen Copper, which is one of the world's largest undeveloped copper mines based in Argentina. And Ron McEwen is spending $70 million plus to bring in a feasibility study, which is expected to be delivered next year. And they have Rio Tinto and Stellantis as major shareholders. So my expectation is that you're looking for protection, but you're also looking at growth in ounces, and that's where I can see a lot of growth in ounces.
Now, this question you probably never had before, but what about the second half of the alphabet here after the N's? Are there just not companies that you follow in that space, or do they just stop naming them after we get halfway through the alphabet?
Oh, I'm sorry. The also ends.
Yeah, so you stop at the ends here. So we go from the A to the N's. What about the rest of the alphabet? I've always meant to ask you, uh, is there just no companies that you like to follow in that
No,
space, or
it's
is that
just
just
yeah,
a happen chance?
no, it's just it's it's a good question. It's just coincidental,
Okay.
more than anything else. It's I'm just trying to think of what I'm missing. Those are the major gold miners, I guess that I follow, and no, it's just by
Yeah.
coincidence,
Yeah, I think it
David.
is. I've always, well, because we put all of your work into our systems as well, and I was saying, it stops at the ends because we sort them alphabetically just so we can get your ratings and
Yeah, I'm
update your
trying to think of
ratings
what
in our
mine that.
system.
Yeah, maybe that's the gold miners. I mean, I
Yeah,
guess so.
maybe let's start a mine, start it with a Z. No one will cover that. Anyways, this has been very interesting. Is there anything else you want to add before we wrap up here?
No, I mean, I think we covered a lot. I think that it worries me when I look at the outlook ahead. We have tariffs coming ahead, and that does not end well. We have an uncertain geopolitical climate with wars raging on. We have a fight, I think, is needless between China and the United States. China, ironically, is the leader in green energy, and we have climate change as a problem here, and they are the answer. They've been able to bring on solar and windmills and that, and we could use that technology, but now because of Taiwan or politics, we can't benefit from that, and we're going to start a needless tariff war, and historically that has ended badly. We have trust in government at lows, not only in the United States, but here in Canada. And if you look at the UK situation, it's around the world. It's a pandemic. And so gold is a very good protector during that. And that is one commodity that I have found historically a good protector of assets. And that's the name of the game.
Yeah, that's exactly right. So, I guess the final question would be, what's your forecast for gold and over what time frame?
My expectation is that a $3,000 gold price within the next 18 months. I've been asked if really things get really out of hand. How does it look? Well, I don't know. Forecasting the gold price is like forecasting the weather. It's awfully difficult. If we get a hyperinflation period, who knows how high it can go. All I know is that when you look on a risk reward, gold has moved up from the low 2000s. 2400 is held, 2300 is held. It's all looking awfully good. And in fact, most institutions have very little gold exposure. So they have a lot of the artificial intelligence. Well, they have the apples. What they do not have is enough gold. And my expectation is that there's so few gold players that some of these prices are going to get way out of whack.
Yeah. Yeah. No, it's a very tight market in gold, and the needle can move very rapidly if any sort of form of interest level change. So, but in the meanwhile, it's not something you can sort of trade around. You almost just have to sit on it and wait. And you were kind enough to present at our last public presentation, and one of the other speakers was with the Royal Canadian Mint. We still haven't figured out a way to buy there, so we'll have to. That's next on our list of to-dos. And then for clients of ours who are still listening at this point, we are looking at just right sizing all of the positions in your portfolio to some of the top names that John just went over a while ago. So this has been great. Thanks a lot for the time. And maybe, Ken, we can shut off the recording, and then John and I will just say our